Hello, everyone. Mike McMeans, president of the 2021 FPA. We're just going to give this a few more minutes here. Wait till about 9:03 to kick it off, just to give people a few minutes to finish dialing in. For those of you just joining, we're just giving people another minute or two to dial in here. Okay, hasn't changed for a few minutes, so go ahead and get started. Welcome to 2021. Mike McMeans, I'm the managing partner here at Silverlink Financial and your 2021 president. I'm excited about this year. The market's relieved by the election being over and optimistic about 2021, and I too am about this organization. The board and I are extremely excited about what we have the ability to do this year, particularly as we try and figure out some transition from remote or Zoom to in-person. Don't know when that'll happen or how that'll happen exactly, but you can be sure that the board is considering all options and making sure that we're figuring out the best way forward. I want to just recognize our 2020 Platinum sponsors or our 2021 Platinum sponsors, I should say. Calamos Investments, they renewed for 2021. Harbor Funds, they also renewed for 2021. Palladium Group, thank you for your renewal in 2021. Lowcore Funds, M. Linton Tech Services, and TD Ameritrade. We also have our 2020 gold sponsors, and actually that list that I read was 2020, just thanking you for that, and a few of you have already re-upped for 2021. Thank you to the gold sponsors, ARM CPA Group, Johnson Institutional Investments, Park National Bank. ARM and Park National, you've already renewed for 2021, thank you. Nationwide, Symetra, Union Savings Bank, and William Blair. Thank you to all of our sponsors. We really appreciate you supporting this organization. Without you, we could not have some of the great speakers we have, like the ones we have today, as well as do some of the additional things that we do for practitioners in the space here. So thank you. I want to also just remind you all to complete your ballot. If you have not done that, please find time to do it. I believe it was, I forget the date that it was sent out. Maybe Debbie Lee can speak to that at some point, but you should have it in your email box. Remember, as we go through the continuing education today, there are 3 poll questions. They're random poll questions that the Ohio Department of Insurance requires in order to get our CE to verify attendance. So you must answer all 3 poll questions to receive credit. Don't have anything else open in your browser, or you may miss the poll question. Q&A. If you have questions for the speakers, please use the Q&A box for those questions. You'll find that on Zoom. It's easy to locate there. If you have another question, you can also email Debbie Lee later in the day at admin@fpacentralohio.org. The recording and the presentation PDF will be posted by tomorrow under past events under our website, or on our website. And just so, I think it's listed on your screen, but this is being recorded. I want to introduce our speakers today. We have Kevin Clark, who you may recognize as a board member. He was a board member last year. He'll be a board member this year. He's a financial planner with Highview Advisor Group in Worthington and the owner of ARC City Tax Services, LLC. He specializes in serving small business owners and W-2, 1099 hybrid workers, and frequently advises individuals on launching side ventures or transitioning to self-employment. Kevin is FPA National's Next Gen President-elect. So we're really glad to have that as well, and serves as the Career Development Director for FPA here in Central Ohio. He graduated from Ohio Northern University. Don't know how I messed that up. And he resides in the short north here in Columbus. Our other speaker is Michael Duffy, not to be confused with the political figure. He's an accounting, income tax, and payroll specialist at Marcoin Business Services in Pickerington. He has 12 years of experience consulting with small business owners and nonprofits on their tax, bookkeeping, filing, audit, and payroll needs, and has prepared several thousand income tax returns for both legal entities and individuals. He holds several certifications and is very proficient at QuickBooks Pro Advisor, as well as some other things. He graduated with his MBA and holds a bachelor's in accounting studies, and he lives in Pickerington. Before I turn it over to them, I thought it was interesting. One of the things that I do to maintain my proficiency just as a human being, I guess, since 2008, I've had a coach, and I wanted to just speak to a couple of things. It's interesting. This whole topic of self-employment. Interesting, I found a statistic, 43% of people worked remote in 2017. I had no idea it was that high. 2017, not 2020, 2017. And I started thinking about it, and there are a lot of salespeople out there. You think about the wholesale community that serves us as advisors, or some of us as advisors. They all work from home. They're all remote. It's a pretty big group. 60% of people say they would leave their current job to work remotely. And working remotely results in a 60% increase in productivity and a 50% drop in attrition. It's pretty attractive, especially if you're a business owner. So I just thought that was some interesting information to kind of prelude to what these guys have to say. So without further ado, Kevin and Mike, take it away.
Thanks, Mike. Just thumbs up. Can everybody see the slide for the PowerPoint? It's pulled up here. Or do I need to adjust that?
It's a blue screen.
Yeah, I think it's a little low right now, I think.
There you go. That's not full screen, but it's visible.
Yeah.
How's that?
There you go. That's perfect.
Okay.
Oh, very good.
All right. So yeah, thank you very much for that introduction. I would encourage any of you, if you haven't gotten your coffee yet, to go ahead and grab that now, because this is what my voice sounds like. And I am down here in Florida after a pretty miserable game last night. But really excited for today's presentation because it is something that is really important to me as a financial planner, and I think more relevant than ever based on what we've had the last 12 months. And that is the idea of how can we help our clients that whether it is a side venture, some type of side hustle, or planning to eventually run their own business, how do we, as financial planners, advise our clients around that decision, around that process? And the reason that I have Mike on here is we wanted to have both the science and the art of financial planning addressed here. So Mike is much more of the numbers and all the information. He is my go-to person when it gets beyond the scope of what I can do as a financial planner. But we want to have this primarily be something that at the end of this, you'll have a few practical tools and discussion points to go ahead and be able to address this topic with your clients going forward. Mike, I'll allow you to kind of share a few remarks if you have, and then we'll get into what this presentation will look like.
Okay, absolutely. Thank you, everybody, for taking the time to sit with us. Mike Duffy at Marcoing Business Services, payroll, income tax, and accounting. I have over, like they said, I have 12, 13 years of experience in this, helping those individuals wanting to become employed for themselves, helping them design a good accounting structure, bookkeeping structure, and tax planning. Trying to advise them the best possible way we can to give them the freedom of business ownership. Working for yourself can be a great thing. And then our goal is to not only help you succeed in that, but also have the best possible tax strategy by maximizing your deductions for your business and keeping the tax ramifications under control. So appreciate it. Thanks for everybody for your time. Hopefully everybody will get something out of this. Give them some food for thought.
Excellent. Okay. As Debbie Lee and Mike both mentioned, please make sure to pay attention, keep this full screen. We want you to make sure you get your continuing education credit in addition to the rest of this information. And if you have questions as we go through, we are going to leave 10 to 15 minutes toward the end. But if it's a simpler question at any point, please feel free to put that into the chat box. If it's really quick, we can work it into our prepared comments. But again, for some of the other stuff, we will hold those to the end and make sure we get to as many of them as we can. These slides also will be available starting tomorrow. So feel free to take notes, but you'll also be able to have access to this in the future. So to give you a quick overview of what we're doing, it'll be broken out mainly into three parts. The first part will be a discussion that I'll provide around when you have that client that is interested in self-employment and in some type of work that they feel is going to be routine or regular, looking at what are the different entity options, how do they set that business up, what their choices are, how they would choose to be taxed. And then a big part of that that I talk with a lot of people about if they are going into self-employment pretty regularly is to set up a limited liability company. So I'll talk about the resources that are available from the state of Ohio on how to do that if you have a client who's interested in adding that to their business structure. Part two, Mike will go into some of the more technical parts of this. So he'll talk about all of the tax requirements that go into a self-employed individual as far as payments, filings, completing payroll if the business is big enough to warrant that. And especially a question I get a lot that I typically turn over to an expert like Mike is when does it make sense to switch to an S corporation treatment? And we'll go through, if you're not familiar with that, what that looks like, and he'll be able to talk about the best time to start thinking about that. Part three then will be split between Mike and I. So Mike will talk about as far as the opportunities when you are self-employed to take deductions, find ways to limit your taxable income, some of the provisions going off of current legislation. I know this is all subject to change with the new administration coming in, but the Tax Cuts and Jobs Act and some of the things that has in place right now. And then I'll finish by talking about, I think, a really big planning opportunity for us is some of the investment strategies, self-employed retirement plans that get opened up by having this type of income available, especially under the Tax Cuts and Jobs Act, that really in some cases limited what a traditional employee is able to save. But there are a lot of additional options opened up when you have self-employment income. So I mentioned that this is really something I feel is increasingly relevant right now. These are some numbers to kind of back that up. These were surveys done most recently. Mike provided some statistics, but these were a survey of W-2 employees, people that have a normal job, salaried, and they did a survey, anonymous survey, asking just aside from your primary job, are you working on some type of side work? Do you have a side hustle or some other supplemental self-employment? Almost half has said that they do have some part-time employment outside of the primary job. But more importantly, nearly 1 out of 5 of those, so about 10% of the overall surveyed, said that they eventually want that side work to become their full-time work. The reasons why people have this is a lot of the reasons why we work with clients. In the good case, they're looking just for some extra money for beverage money, additional spending, or to work toward those financial goals they talk with us about. Unfortunately, there are also a lot of people, especially over the last 12 months, that are doing it out of necessity to cover their expenses, to get rid of some of their more toxic high interest debt. But a lot of people are looking at this, and this, I think, is really relevant even with retired or retiring clients right now. 1 in 3 people that have one of these is over age 50. 27% of them basically need that job to cover their bills and their retirement lifestyle. So the biggest thing down there, the reason we have Mike on here to talk about, the other issue is a lot of people going into this look at the income. They don't think about the taxes that result, that were kind of automated through their company's payroll. And 1 in 5 of people in their first year of having one of these side jobs ended up not doing the correct thing of withholding their taxes and had a big bill due in April. So just again, all of these are dated BC as well, before COVID-19. So when these are resurveyed, I fully expect that they're all going to be going up based on all the issues we've had over the last 12 months. But I really think this is something that you should be working into most of your reviews, because a lot of your clients either have it or are thinking about it, talking with their neighbors, other people about ways to generate more money. And at the very least, it warrants the discussion, and especially discussing their retirement planning. A lot of people, I think, going forward are going to look at retirement not as a time when they stop working, but as a time when they have the freedom to either pivot or leave that primary job and pursue something self-employed that is more of a hobby, a passion, a second career. So you now have a client sitting across from you, and they've expressed that they do want to have some routine self-employment going on, or would like to launch a business. You have the first decision is, how is it going to be taxed? What type of company you're going to set up? The easiest by far, if you are just in business for yourself, no employees or anything, is a sole proprietorship. And if there's more than one person involved in the business, that is a partnership. Those are going to be the simplest ones to set up, much less tax reporting filings compared to some of the other options we'll go over. The income goes on a Schedule C for sole proprietors. For Schedule E, with income from partnerships, your share of that income and expense, as well as rental and investment properties. Both of those are just attachments to your personal tax return. So you're going to have a longer tax return, but you're not going to have to do separate tax filings versus some of these other options. Where you pay for that simplicity is in, you do have some additional liability, potentially unlimited liability, although the LLC helps a little bit there. And you are paying full self-employment taxes on all of that income, with the one limited exception of, in a partnership, if you just have a limited or investing person not actively involved, they might be able to avoid that self-employment tax, but for the most part, you are paying full self-employment tax, which we'll talk about what that looks like. The second option, this is really in here just for being comprehensive, but I typically tell people that this should be your option when you have no other options. You could do a C corporation. The most recent tax legislation did reduce the corporate tax rate to try to get more competitive with the rest of the world's. You do have a little bit of limited liability since it's a separate entity from you, but this is typically the last place you want to look if you're not eligible for some of the other ones we talk about, because it is a completely separate entity, separate tax system. You're going to have to complete a Form 1120 to do a corporate income tax return in addition to your personal income tax return every year. It's expensive. There's a lot more stuff that goes into it, and all of the income is taxed twice. So the corporation gets taxed on the revenue that they earn, and then anything that is passed through to you as the owner or the officer of the company is then taxed on your personal return again. So typically want to avoid these, but just to make sure it's in there. By far, the much more common one that Mike and I see is this S corporation. So these are companies that are established, have a really good amount of earnings behind them, enough so that switching from a sole proprietor or a partnership makes sense from a tax perspective. And you are going to have to do a separate 1120S, which is for the S corporation. But the advantage is that you don't have that double taxation. Everything is then passed through to your personal income tax return as a shareholder. You still have a little bit of limited liability since it's a corporate structure. And then as a business owner, you can save a lot as you scale by having a lot of those net profits avoiding self-employment tax and being passed through rather than taxed. There are stricter requirements you have to meet. So as an example, the one person I've come across that had to do a C corporation was disqualified for doing this because they didn't meet the requirements. Mainly has to do with how many shareholders or people own the business and who owns the business. So in this case, there was an investor in a business that was a non-resident alien. They were actively involved investing in the business, but not located in the United States, not a US citizen, and that disqualified the company from taking advantage of the S corporation and forced them to do a C corporation. So it is costly because you're having payroll in this case, but once you get to a certain size and above, this definitely makes a ton of sense and is where you would want to pull in some of the professionals like Mike or an estate attorney. Limited liability company. This is actually not a tax treatment, so it is something that you can put around your business to insulate and protect yourself, but the actual taxation goes back to the three items that we've discussed already. So a one owner limited liability company would be a sole proprietor treatment by default. That's also called a disregarded entity. Multiple owners of a limited liability company defaults to partnership. You can elect a C Corp or an S Corp, but that requires filing the election through the Internal Revenue Service. And again, the biggest thing here, especially in the state of Ohio, relatively inexpensive, significantly limits your liability by protecting your personal assets from creditors in a lot of cases. If you have multiple businesses or sources of income, you can segregate each of those from each other. Disadvantage, so each LLC has to be separate, separate filings if it's corporate, but this is certainly something for somebody that's serious about self-employment or running a business or multiple businesses, something I typically really strongly recommend that they look into for that additional legal protection. And just an overview now of where the income from these businesses is reported that eventually ends up on the tax returns. Sole proprietors, this is fairly new, a 1099 non-employee compensation. It used to be a 1099 miscellaneous. As of this year, that is a new form specifically for independent contractors or gig economy workers. If you're not familiar with gig economy, that would be somebody plugging into a company's existing infrastructure and acting voluntarily as a member of that community in a self-employed capacity. So classic examples, if you're part of a ride sharing program, you're driving for Lyft, Uber, if you're delivering food for Postmates or DoorDash, or if you're selling inventory or crafts on Etsy or eBay, all of those are gig economy types of jobs. Some of them have different ways that they report their income in the case of a gig economy, but in general, a sole proprietor and LLC disregarded entity is going off the 1099 NEC. Partnerships and S corporations, since you are receiving a portion of those profits, if there's more than one people, you are going to get a K-1 every year that reports all the items that go on your personal return there. A C corporation is again separate, so if you are involved as an officer, you'll get a W-2 statement for your wages and salary from the company. If you have some form of employee compensation or executive compensation, stock awards, that would be a separate 1099. And then if any of these businesses have somebody not owning the business but working or employed by them, an employee would get a W-2. And if you have a contractor that's helping with your business, they would again get that 1099 NEC. And lastly, before I flip it over to Mike for section 2 here, registering an LLC is actually very simple in the state of Ohio, particularly if it is just you that is involved in the business and you're setting up that single member LLC. There is a checklist that's published on the Secretary of State website that goes through steps 1 through 10. But in most cases, a single member business, you only have to do steps 1 through 4 on that list. Step 1 is you pay the $95 to register the LLC with the state. Step 2 is you create a federal tax ID number with the IRS. That's no cost. Step 3 is setting up a business banking account. Again, really cheap to nothing if you already have a banking relationship. And then step 4 is just making sure that you're not subject to any special or excise taxes by going through the Ohio Business Gateway. So really simple process for single members. Where you would want to engage those other professionals is some of these other situations. If you have complex ownerships, corporate structures, if it's not an even split with multiple owners as far as expenses, profits, if you have 2 different types of partners in a partnership, or if you have other people involved in the business that are working for you but not owning the company in some capacity, or you expect to hire people, all of those are things where you would want to get a professional involved. But again, the key takeaway for somebody just starting out, this is a really inexpensive, good way to help protect themselves as they launch into self-employment. And I will turn it over to Mike now.
I think there's a poll question that popped up.
Not supposed to say that.
Okay. I just didn't want to talk over if somebody's going to move this out of the way here. I can see. Okay, great. Good morning, everyone. Yes, thank you, Kevin. Excellent job in covering everything when it comes to the different types of entities that anybody may choose to be. Really what we're looking at here is to try to simplify this. I don't want to get too technical detailed on all this and get everybody lost or confused. So what we really want to focus on is what? Many of you are going to embark on becoming your own business, becoming your own boss. And that is a huge, great step. It gives you freedom, gives you lots of different things that go along with the pride of business ownership. So it's fantastic. So when we talked about earlier, self-employment tax, what is that? It covers both employers and employees' contribution to FICA. So what does that mean? As an employee, if you work for someone now, you get a paycheck. And on that paycheck, you have Social Security and Medicare tax. That's 1.45%, and Medicare 6.2 Social Security, okay? So that's what you get withheld out of your paycheck. When you are self-employed, the IRS says, fantastic, you're self-employed. So you get to pay that 7.65%, but you also are the owner too, aren't you? So you're the boss. So you have to match that, just like your employer does currently now. If you work for someone and you get a paycheck, they have to match that Social Security Medicare withheld. Well, congratulations when you're self-employed on that income, like a sole proprietor or a partnership, that income that you make, that's your taxable income, that's your gross sales minus all your expenses. Boom, there's your income. That is taxed at twice for the FICA. So that's Social Security Medicare twice. That's 15.3%, which in many cases, that is as much as the federal income tax. And let's keep that in mind. Self-employment tax is not income tax. So that tax you're paying on that dollar amount is in addition to the income tax, which in many small business, especially starting up, is very often equal, 15% income. So you're paying 30% on that self-employment tax. It's great freedom to have, and it's a wonderful thing, but it is costly. So let's say I'm self-employed, but I want to become a different entity. I want to become something like a sub-S corporation. So you file your LLC with the state, which is very, very easy to do. You can even do that online yourself. Then I would see an attorney or a respective accountant, and you can file for what's called a sub-S election, Form 2553. It is designed for businesses like yourself, small businesses. And what that means is that now that income flows over, like Kevin talked about, whatever the business makes. It's not taxed at the corporate level. It passes through almost like a 1099 NEC, really. It's just a statement you get and you have to pay. That goes on your personal return, and it's part of your income. So to do that, though, you must be on payroll as a shareholder in the sub-S corporation. So, and what the IRS requires is that you pay yourself a reasonable wage for work performed. So you can't avoid self-employment tax on that income that you make and pay yourself $10,000 a year and you made $100,000 and avoid $90,000 worth of taxable income to self-employment. So reasonable wage. So what that means is now what's payroll taxes? Just like your employer is paying on you right now. If you were an employee for someone, your employer pays the contribution like we just talked about to FICA, the federal unemployment tax, which is a very small percentage, 0.6%. State unemployment tax can range anywhere from 0.9% up to 5%. And your folks' line of work, it's the SUTA tax is a very, very low rate. It's usually around the 0.9 to 2% usually. FUTA, the 0.6% we talked about, that is same for everyone, no matter what the business. Your employer pays 0.6% on the first $7,000 in wages. SUTA tax, we talked about, just mentioned, anywhere from 0.9 to anywhere from the 5% range. Your folks are going to be more like around the 2, probably 1 to 2%. That's taxed only at the first $9,000 in wages. Bureau of Workers' Compensation payments. Here's the beauty of Bureau of Workers' Compensation in the state of Ohio. If you are a sub-S corporation, sole owner, and you have no other employees, just yourself, you just decided I want to become a S Corp to take advantage of the tax benefits, you do not have to have workers' compensation coverage, only until you hire that other employee. So it's 2 or more. If you hire someone else, 2 people on payroll, then now you have to be covered in workers' comp. And again, with your folks' line of work, workers' comp is what? Workers' comp is nothing more than if you get hurt, it's an insurance. And because of the type of business that you folks are going to be doing, it is not necessarily considered a high risk injury type of work. So your workers' compensation rates for those that we have in your line of work is very, very low. So again, even those are payroll taxes and they've got to be paid, they really, really are a much smaller amount. The FUTA, the SUTA, the BWC is a very small amount for the amount of tax you're going to save becoming that S Corp. Commercial activity tax, $150 per year assessed in business with gross receipts between $150,000 and $1 million. So most everybody's going to qualify under that. Once the business gets set, if you go over $1 million, fantastic, pay that extra commercial activity tax. But it's a very, very low dollar amount. And then obviously the higher amounts go there. So payment requirements, quarterly estimated taxes. What is a quarterly estimated tax? Well, when you're no longer just an employee getting a W-2 from someone, the IRS says, okay, we're not going to allow you to go all year long, or we don't want you. You can do it, but we're going to penalize you, but we don't want you to go all year long without paying us some of that money. So really what we do is you'll visit with your accountant and going over your books and your profit and loss statement, how much are we making? They'll do an estimated tax on that, and those are the due dates: April 15th, June 15th, September 15th, January 15th. For any of those income taxes, because they don't want to wait. Your tax agencies are not going to wait all year to get have your money. So payroll tax withholdings, typically monthly and quarterly payments of withheld taxes for smaller payrolls. Larger payrolls require more frequent payment of withheld taxes. Again, that all goes back to the agencies that the more you're making, the more you owe us, the quicker we want our money. So that's really the bottom line with that. Filing requirements for small businesses with payroll, W-2s for owners' wages, and if you have a hired employee for your business. In Form 941 quarterly withholding reports, the 941 is nothing more than that Social Security and Medicare tax and federal withholding that's withheld from the paychecks. You got to do a reconciliation on 941 return, no problem. For small businesses with non-owner workers, Kevin alluded to this earlier and talked about it, the 1099 NEC for contractors. So for those of you that are going to receive a 1099 or used to receiving a 1099, you're going to see NEC. It'll say 1099 NEC, which is brand new for the tax year 2020. So when you look at it, don't think it's something wrong. It's actually IRS changed it. So it's just for those NEC, those contractors. And of course, I think pretty much everybody's familiar with the W-2. It's a statement of your taxable earnings, the taxes withheld. It's just kind of the year-end reconciliation, how you report your income. For partnerships and S-corps, the K-1 to report to the pass-through items for individual partners and shareholders. That's what I was talking about and Kevin was talking about. The K-1 is, think of it like a 1099 or a W-2, basically. It's just not going to have any withholdings on it. It flows through from that sub-S corporation that files its tax return, doesn't pay its tax. That income goes to the shareholder, and then it's reported personally on your tax return. Hope that makes sense to everybody. Converting to an S-corp. The added costs converting from a sole proprietorship or partnership tax treatment include payroll processing and tax and withholding requirements, what we just talked about. So because you're now an S-corp, you've got to be on payroll for reasonable wage for work performed. And what is that exactly? That's, well, what would you pay someone to do your job? Obviously, we'll look at how much money the business is making. IRS doesn't expect you to pay somebody $80,000 when the business only made 50. So that obviously comes into play. Attorney's fees and articles of incorporation for multi-owner entities. Again, that goes to the setup of the S corporation. When you set up an S corporation, the important thing to do is see a trusted attorney of yours and set up an articles of incorporation. And that is not what you're doing when you create an LLC with the state of Ohio. Articles of incorporation is going to list the kind of stock, and with an S corp, you can only have one kind of stock, and it's going to list on who the officers are and what the responsibilities are. It's just something that states what that entity is all about. And those you'll pay an attorney fee or an accountant's fee in order to apply for those. Tax benefits of converting must outweigh cost to convert. These include net profits avoiding SE tax, 15.3% discount. And what is that? Well, because we talked about you're going to be on payroll now with the sub-S corporation, right? So you're going to pay a payroll company or somebody to do your payroll and the tax filings, the withholdings, and all the year-end reconciliation. So there is a cost to that. Owners can create qualified plans to shelter access from income from taxes and maximize savings. Absolutely, and that's where you folks obviously come into big time play on that, is getting them some investments and getting them set up. When it usually makes sense to benefit outweighs the costs. I'll give you a little example. $80,000 or more of net profit from self-employment for each LLC or partner. Other employee compensation may impact this number. Why 80,000? Well, think about it this way. Because you are an officer of the corporation, you may be just yourself, you may have a partner, but you're both on there, right? So what are you going to pay yourself? Well, most of you folks, I would think if you're just starting out, you're probably not going to want to pay yourself less than anywhere between $40,000 and $60,000. Well, once the business makes $80,000 without my payroll, without my wage in it, if I pay myself $60,000, now my $80,000, my net profit's now 20, isn't it? Well, you take 15.3% of 20,000, you get a number, and that number then compares to what it actually costs to those extra fees to create the sub S corporation, to be on the payroll. So that's kind of that $60,000 to $80,000 magic number, to where once I start making enough money to reach that $60,000 to $80,000, that's when I want to really take a look at becoming a sub S corporation. So the goal is not to own your own business, be a sole proprietor, then immediately turn it S corp, because you want to have a good standing and a good foundation for what the business is doing. So if the business is really starting to make some good money, once you hit the $80,000 mark, that's when you want to take that sub S corporation, because you're going to shrink the amount of self-employment tax, because you're not going to pay self-employment tax on that profit anymore, because you're a sub S corporation. And the other beauty of it is that you still get to take draws out of the business. So yeah, that's really what covers what it becomes the $80,000 profit. So hopefully that makes sense to everybody. So it's, again, not jumping out and hurry up, let's become an S corp, but it's once I reach a certain profit around that $80,000, that's when I want to look at becoming an S corp, taking myself a reasonable wage for work performed, so I can save on that self-employment tax. Business tax deductions. Self-employed individuals can deduct several items related to their business. This is a fantastic description of why, how much easier it is to have business deductions when you own your own business as compared to an employee, which many of you may know already that during the the Tax Cut and Jobs Act, that in 2018 it started, that no more can we as employees working for somebody else deduct any business expenses. We must be reimbursed by the employer. So as your own business, when you're self-employed, whether you're a sub S corporation or sole proprietor, now all those become deductible if they're related to business. Home office expenses must be exclusive use. You can't use your couch, and you can't use your bed as your home office. It has to be exclusively used and regularly used. Many times, like a den or a small bedroom is converted, that definitely qualifies. Mileage or expenses for business auto use. This is huge. I can't tell you how many times I've seen folks in even your type of business prior to, I guess, what 2020 brought us with the COVID virus, but when people were traveling so much more and visiting people, track your mileage, 57.5 cents a mile this year. That's a huge deduction, especially if you do any kind of driving. Business meals, 50% deductible. As long as you're meeting with a client, those kind of meals are deductible. Business travel, if it's business, 100% deductible. Bonus depreciation or Section 179s for computers and furniture. All this really means is that you can take all that expense and deduct it in that same year if it's put into use for gain of the business. So starting off, not always we will do that, but as your business is making money, you need to buy equipment, definitely do it, we'll deduct it. Advertising and marketing, office supplies, everything that has to do with business, it's an expense. Professional membership fees and subscriptions, I think you all know what those are. Health insurance premiums are deductible, even for the spouse and any dependents you have. They are considered insurance deductible and health insurance premiums for the business, as long as it's not offered by the spouse's employer. Equipment converted to business use, that's a big one. A lot of times we see folks that, well, I already had this computer, or I have this desk, or I already had this, I brought it in. Well, that has a value. Put a value to it at the time, a fair market value when you brought it into the business. That is an expense. Other expenses occur to operate the business. There's a whole list of things, and once you start doing business and setting up your own business and seeing what everything costs, then you'll say, okay, ask your accountant, is this deductible? Is this not deductible? Very good.
And while we're on here, Mike, one of the questions just came in. Just wanted to confirm, business meals are 100% deductible when provided for employees to increase their productivity?
Yes, as long as there's different stipulations on when it comes to that, on what you can provide an employee is called employee benefit. They can be taxable depending on what type of benefit it is. If it's a small amount, like you can give turkeys away at Christmas, that's not something they have to show as income, but it's still an expense of the business. But yes, if I hold an employee party and it's to benefit everyone, it's not exclusive to certain employees, or especially the higher wage earner. But yes, they will be deductible if it's for the benefit of the employee. Definitely deductible. So we have another one here. But reasonable in certain industries much higher than 80,000, right? Let's say, for example, principal.
For a registered investment advisor.
Okay.
So just kind of a commentary on what's reasonable compensation.
Okay. Well, reasonable compensation is what you will research the market at. So whatever your market bears, you can do the search online if you want to. How much does so and so this type of position make in this area of the country? And that's where you have to look at too. Don't necessarily look at something in New York and try to compare it to somewhere in Southern Ohio, because obviously the expenses are much higher and the cost of living is much higher. But what would you pay? Again, I'll go back to what I said before. What would you pay to someone to do your job? You're the business owner. What would I pay you to do my job? And again, the structure, how much the business makes, can determine a lot of that too. IRS is not going to expect you to pay 80,000 when the business is going to make 80,000 and it's all gone. The profits are all gone. So it's a reasonable wage for work performed, and there's all kinds of different things you can do to find out what that is in your line of work. Long-term care insurance premiums deductible in a sub-S corporation. Yes, they are. And actually on your personal, they are too. So they are deductible. What happens there is, as a sub-S corporation, this is for Barry asked this question, are long-term care insurance premiums deductible? They are, but they're also taxable. So the entity, the corporation, the sub-S corporation can deduct it, but will be on your paycheck and be reported on your W-2, so you'll pay income tax on it. You won't pay Social Security, Medicare, unemployment taxes. You won't pay those, but you will pay federal, state, and local income taxes on those long-term care insurance premiums. So does vehicle use have to be greater than 50% use? Absolutely. That's where the mileage is huge. Whether you take the mileage deduction, and here's the thing when it comes to vehicles, real important. You can take a mileage deduction, or you can take the actual cost. The actual cost is the gasoline, insurance, et cetera, on that vehicle, and even depreciate the vehicle. However, mileage you have to track regardless, because if I only drive 20% of my total miles, I drove 50,000 miles, and only 10,000 miles is for business, I only get to deduct $10,000 or 20% of the gas, only 20% of the insurance, only 20%. So that's why the mileage will have to be tracked regardless. And there's lots of great apps out there, Mile IQ, et cetera, that you can use to do that. They're very simple, but the mileage definitely comes into play regardless if you take actual expenses or the 57.5 cents a mile for 2021 for the deduction. So also, health insurance premiums do not save self-employment tax where others do. Not that it's wrong on that side, but that's a common difference. Yep. That's exactly right. Your health insurance premiums are deductible. They do not save you on self-employment tax. So that is correct. Very good, Kristen. Did I miss any? I hope everybody's clear on the self-employment in the vehicle.
Okay. Can you see the next slide now?
I've got this poll question here. Let me see if I can get that one. These poll questions here down at the bottom. Tax Cuts and Jobs Act, TCJA. Qualified Business Income Deduction, QBID. Up to 20% of net income for sole proprietorships, partnerships, and S corps, and similarly taxed LLCs. What that really means is that, yes, it's about a 20%. There's a calculation to it, but it's basically 20%. And what that means is it reduces your federal income tax liability. It has nothing to do with any type of self-employment. You're still going to pay self-employment tax and all of it, but it reduces your federal tax liability. And key deductions eliminated: unreimbursed employee business expenses, business entertainment, and other 2% miscellaneous. I alluded to it earlier. We used to be able to, even as a W-2 employee, called a Form 2106, we used to use on our tax returns that we had any expenses that I spent in my work that my employer didn't reimburse me for. So those were eliminated in the TCJA of 2018. So IRS basically simply said, they simply to the employee said this: if that expense was needed and necessary, why is your employer not reimbursing it? So really the bottom line is it's much easier for them to govern and monitor the companies as opposed to all the employees. So they may basically put it on the shoulders of the employer themselves. State and local tax deductions, SALT cap, 10,000 max, includes real estate taxes paid on the home. Yes, part of the TCJA. That comes really into play for those that the higher income earners is really what that did to cap it for those that have really large homes that have high real estate taxes, expensive homes, and those that pay a lot of state and local taxes. And if you're paying a lot of state and local taxes, it means you're a high income earner. So that definitely capped it at that. 21% flat tax for C corporations, reduced from 28%. Also eliminate corporate alternative minimum tax. That's a wonderful tax, alternative minimum tax. You really didn't pay enough, so really hit this mark, you need to pay a little more. That's basically what that comes to. Standard deduction nearly doubled, personal exemptions eliminated. Individuals are less likely to itemize their deductions. Definitely have seen that since 2018. And when they doubled the standard deduction, that definitely was a huge one. And also when they increased the child tax credits, that was a big one too. So.
Okay, thank you, Mike. So we're on the home stretch now. I know there's a few questions still outstanding. We'll hold those to the end for Mike to answer, but Mike just talked a lot about one of the opportunities from being self-employed is the ability to reduce what is taxable. I think a much bigger area of focus that we can talk to clients about is around how self-employment can greatly increase what we're able to save toward our goals. So this is something I've talked with a lot of clients about recently who are employed, are kind of capped out, or have just really the IRA as their option for contributions, but really have the capacity and willingness to save more. This self-employment is really where you can contribute a lot of money to either shrink the time frame for being able to accomplish those goals or to increase the likelihood that you'll be able to. So this is where I really think if part of your financial planning is around investments, whether you do them in-house or make recommendations to implement elsewhere, there's a lot of plans available here. The two that really help just maximize the amount for those really successful business owners, people with a lot of self-employment income that really just need to shelter as much money as possible, is the 401k profit sharing plan and then a defined benefit plan. A lot of the really successful white collar types of professionals do both of those. And we'll talk a little bit about what a solo K can do for a single owner business, which is a simplified version of that 401k profit sharing. You also have the access to some of the other plans out there. A SEP IRA, a simple plan, and a health savings account is another one that not necessarily restricted to self-employed individuals, but it does offer a deduction if you contribute to that, and we'll talk about that as well. So just checking here. All right. The first two I mentioned, these are plans for really high income earners that are looking for flexibility and or just sheltering as much income They're getting killed on taxes, and their interest is trying to defer those taxes out into the future. 401k share, profit sharing. The solo K is something I have talked a lot with people. This is great for people that run their own white collar law firm, accounting firm, solo practitioner types of work. Realtors are another one. Basically anybody that runs their own business, they don't have any employees, or if it's a joint venture between spouses, again, with no other employees, they would qualify for this simplified individual or solo K. The advantage, again, you can defer up to $19,500 of your net profits for a sole proprietor or partner. If you are an S Corp, then it is based on wages for those deferrals. So you need at least $19,500 of W-2. Again, if you're at that level, you're going to have much more than that on your payroll. And then you can also profit share with 25% of the salary amount that you pay yourself in W-2 out of those net profits. And both of those can reduce what's taxable, just like if it was an employee 401k. You still have that flexibility of both traditional and Roth, and there is no phase out like a Roth IRA based on your income if it's in a 401k. $6,500 is the catch-up allowed, so that then takes it to $26,000 of W-2 wages if you're 50 or over, plus the 25% of salary profit sharing, and all of that is capped at $58,000 a year. So really high earning individuals, I've seen get put $30,000 or $40,000 just into this plan every year based on what they're paying themselves and how profitable the business is if they have a couple $100,000 in terms of their profit margin. Defined benefit is for people that exceed even that $58,000 and they still have a lot of money and they're still looking to shelter. That is really, there are other limits applied to it without getting too technical, but it's based on an actuarial calculation as far as what goes in there. Goes around your W-2 wages, your age, how much money is in the plan. If there's other W-2 employees, those also are considered and usually require some form of annual contribution. But again, these two in particular for your highest earning clients are a great way to shelter a lot of income and reduce current year taxes if that's a concern for the client. Simplified options, if you don't want to go through the whole process of hiring a company and setting up, doing all the IRS filings and startup costs for those two plans I just mentioned, you have your SEP IRA. That effectively is capped at 20% of your net profits if you are the owner of the S Corp. All of it is paid employer rather than employee and employer contributions. And if you do the 20% and you have employees, it requires that all of those employees receive 25% of their W-2 salaries as a contribution to the SEP. The nice thing about this, there's no annual requirement to do it. It's very easy to set up through any brokerage company. But that is one option if you don't want to go through the whole process of a 401k or defined benefit. Simple plan is another one. It's not something I see too often, and it does have a lot of restrictions around it compared to some of these other ones. $13,500 of W-2 or $16,500 if you're over 50 out of your wages that you can defer. Some of the restrictions, though, you need to stay in this plan at least 2 years to avoid a really high penalty for withdrawal. Everybody's got to be eligible. It's capped at 100 people before you're disqualified from this plan. And then you are required to contribute money. So there's no testing. You either have to match 100% of your first 3% for each of your employees' contributions, or each employee has to get 2% of their salary every year, regardless of whether or not they're deferring money into the plan. That's always an option. Again, it's got a higher threshold for contributions than an IRA, traditional or Roth, but that is something that's still out there. And then health savings account. This is something I recommend a lot now for self-employed individuals. Contributions by the business owner are 100% deductible dollar for dollar, versus if you put it into a SEP, it's not dollar for dollar. It does have that limit attached to it, so $3,600 individual, $7,200 for family. The big thing though is you have to be in a high deductible plan with no other coverage available. So examples of where you'd be disqualified here: if you have secondary coverage that is not high deductible, like military TRICARE, you are disqualified. If you're eligible for Medicare, you're disqualified. If your spouse has health insurance that you can participate in that is not high deductible that they elect, you're disqualified. So it has to be, in a lot of cases, single business owners or joint spouses going in a business together. But this is a great option. You can invest the money again, and you get a full tax deduction up front, plus the benefit down the road of if it's used for health expenses, all of it, including the growth, is tax-free. So you get basically a triple tax benefit out of that plan. It's something I'm recommending a lot for business owners right now, in addition to all the other saving they're doing. And that kind of closes our prepared remarks. So it looks like we had a few more questions come in. Mike, I'll kind of defer to you on some of these. So first one, your opinion or just kind of a little commentary: what happens if they get rid of state and local tax and increase corporate taxes early this year for future tax years 2021 or 22?
Well, the bottom line there is that the IRS and legislation could do anything they want. I've seen them retro it. I've seen them retro it to 2020, even at this point. They can still make that decision generally up to really this month. Do I expect it? No, I don't think so, especially with what everything's going on. But that they can really choose whatever year they want, and it depends on legislation. Again, I've seen them go backwards on things. I've seen them call for it in the future. So that's really a decision by them, and it's kind of a wait and see.
Okay, perfect. Couple questions around long-term care insurance. So recently had a self-employed client where the previous CPA deducted premiums for a hybrid life and long-term care policy. Still need to look into it, but thought it was incorrect as it wasn't traditional long-term care. Any insights on that?
That's a good insight for Kristen herself, just to mention it. But yes, there's different types of insurance that are deductible. Long-term care, like I was mentioned before, long-term care premiums, they are deductible for the business if the business pays them. But again, the employee, the key here, the employee being this single member sub-S corporation, has to report it as taxable income. So very often it'll just put it right on the W-2 as taxable income. When you start throwing different types of hybrids into it, that's where it can mess things up. And that's where really you got to do a little bit of research on with the IRS to see what they determine as what is deductible when it comes to long-term care. There's a max limit. There's a limit to it anyway each year, whether it's an individual or an individual sole owner on a sub-S corporation. So good question.
Okay. Kind of on that, if the business pays traditional long-term care insurance premiums, are the benefits taxable or not?
Yeah, like I was saying, there's long-term care. The business can deduct it and pay for it, but it has to be reported on the W-2, the paycheck of that single member S corp for that's paying for. They have to pay the income tax on it. They get to deduct it at business, but you have to pay personal income taxes on it. Not employment taxes, but income tax.
Okay. Insights on if giving up qualified business income deduction on S corp payroll W-2 is worth saving self-employment tax on the profit of an S corp at this time.
Think about it this way. Self-employment tax is 15.3%, like we were talking about earlier. So if you make, so really for every, what is that? For every 20,000, that's about 2,800, $3,000. So that's why we gave that example earlier about 80,000 reaching that mark. If I pay myself 60 in wage, my business made 80,000, but I paid myself 60 in wage. Now the business only makes, because the wage is deductible to the business, makes 20,000. For that dollar amount, you're looking at about $2,800, $3,000. That's where you look at this and say, okay, what did that save me? What else do I got to pay on top of that? Whether it's like becoming the S Corp and being on a W-2 and paying for the payroll processing and the cost to do the sub S corporation tax return, et cetera. Usually that's why that mark, because when you add up those expenses, that's really kind of where that mark is. The reason why that 80,000 is kind of that hit or miss when you're going to pay yourself around 50 to 60,000. So.
All right. And for a business owner traveling out of state or an overnight trip, what's deductible for their meals and lodging?
Well, it's all deductible if it's business. It has to be, and you want to have very good documentation of this. Just keep this in mind, because IRS knows that they're allowing this as a deduction. When you're as an employee, it's no longer, if you had to pay it out of your pocket and the business, your employer didn't reimburse you. Now that you are able to do this as a business owner, it's very important to have good detail on it. Keep the invoices, receipts, stating who you met with, what it was about, dates and times. But yes, absolutely. Anything to do with business is going to be almost, it's deductible if it has to do with the gain of your business.
If they don't spend the night, aren't there limitations on how many meals can be deducted?
Yeah, that's absolutely correct. And absolutely, if you don't stay the night, it's called a per diem. Then you can take the per diem on it, and that gets into some detail of it. But yes, if you don't stay the night, then there's difference in distance and traveled. There's different kind of regulations on it. But yes, not staying the night, you still get to deduct like a per diem on meals, and there's mileage deduction too if you're driving or flying, whatever that case may be. But yes.
Okay, and then the last two I'll take here. So does retirement and subsequent rollover of a simple IRA into an IRA avoid the 2-year penalty? It does not. That 2-year is pretty much across the board. There's no exceptions. So that is a big drawback of the simple plan, is it has to stay in there 2 years, or I believe the penalty is 25%. If you take it out, roll it over to anything other than another simple plan during those initial 2 years. For a spouse on Medicare, regarding the HSA, it goes by your individual coverage and what's available to you. So if it's just your spouse that's eligible for Medicare and you are not, as long as you don't have access to any other disqualifying coverage, their coverage under that is not going to impact you, and you would be able to contribute to your own HSA. If it's a family plan, that's probably disqualified, but individual might be okay. Great questions. So if simple has been open 5 years, no penalties to rollover. That's correct. After the initial 2 years, there's no restrictions that can be rolled into any other qualified plan and get normal rollover treatment. Okay, it looks like that cleared out the queue. If there's any other questions for either of us, feel free to reach out by email or text, anything. But really appreciate all those good questions, and I'll turn it back over to Mr. McMeans to close us out.
Yes, sir. Thanks, Kevin and Mike. We really appreciate you being here today, taking time out of your schedules to do this. Great detail, great information, and thanks for attending, everyone. Have a great month.
Thank you.
Thanks, guys.
Thank you.